Thank you. I'll hang around for a couple of more hours with them. So thank you so much. As Samson mentioned, I'm Nico Stubblefield, and I'm just elated to be here with you all today. So I am the Vice President of our Membership and Community Development team, and part of that team is we have a focus on financial education. And giving back to our community and truly just being good corporate citizens. That's it. That's solely the reason that we are here and hoping to set you up for success, right? So as you go along, some of those foundational principles. So Courtney Dawson is our financial education specialist, and she'll have command of the room in just a minute, but I want to say thank you so much, and even with the liquid sunshine coming out to hang out with us for a little bit today. So here's what I'd say. If there's a way that you can make me money or save me money, you have my attention. Would you all agree?
Yes.
Okay, there you go. Any Hook 'em Horn fans in the room today? No Texas fans in the room? Thank you. There you go. There you go. There you go. Yeah, so this isn't rocket science, right? That's it. If there's a way that you can make money or save me money, you have my attention. And so that's some of the things that we want to look at. And so we start kind of as a springboard with understanding the credit. And so that survey that you have, so if you will just kind of finish completing that, and you can send it to the end of the rows and I'll come and get it. It just kind of gets you thinking about, what are you looking for, not only in a checking account, but in a financial institution. Now, of course, the depth and breadth of everything that we have to offer, we would love for you all to be a member of the credit union, but I would say to you, do your research. Find a place, find a financial institution that's going to make you money, save you money, and provide some financial wellness from beginning to end that's going to be of benefit to you. And so that's why that information is cool to us, and it's letting us know what you're looking for, but also for you, it's kind of getting you attuned to what are you looking for in a financial institution. So do your research, find a financial institution that best fits your needs. But for today, we're going to talk about some of those foundational principles. And so understanding the credit, right? The credit and debt management is rocket science. But hopefully after today, you'll have a nugget or two that you can take away with you to incorporate. Because it's about building wealth, right? Not debt. And so we want to help you do that. Is that okay? All right. So Courtney Dawson, I'll let her come and take the floor. Our financial education specialist at the credit union. Thank you so much.
Thank you. Thank you, Tricia. Thank you, Ms. Nico.
Sure.
Thank you, OTC, for allowing me to be here. I am so excited. Let me grab my materials here, my clicker. And Ms. Nico kind of already got into what I was going to ask you all. My first question is, what do you guys think of when you think of financial wellness? What comes to mind? Stability, for sure. Anything else? Say that again. No debt, absolutely. Financial freedom to be able to do whatever you want to do with your money. Not paying creditors all the time. A lot of people are wanting to be financially well for generations coming after them as well too. Not only looking out for themselves, but those generations to come. Okay, so financial wellness, basically if I had to summarize, is taking what you know about money, credit and debt management, and applying it to your everyday life in order to make sound financial decisions, okay? So we're gonna talk about how to do that in this presentation. We are going to look at what lenders are looking for when approving credit, and also those factors that affect your ability to qualify for credit. We're gonna examine those and how credit is scored and the impact of money management has on your future credit standing, okay? So let's go ahead and get right on into it. So why does good credit matter? Well, good credit matters because it affects the rate that you receive on your loans, such as car loans, mortgages, credit cards, and personal loans. And who also knew that good credit also gives you better insurance premiums? Did anyone know that already? Okay. And who also knew that your employer also looks at your credit? Okay. Yes, not a lot of people realize that your employer actually looks at your credit as well, because your credit report tells a story, okay? It says a lot about you. And good credit also allows you to qualify for different housing options. Okay, it makes a difference as to whether you can own a home, rent a home, what kind of interest rate you will receive, okay? So you definitely want to make sure your credit is in great shape, all right? Let's see. Okay, so your credit report, it tells your story, all right? Your lenders can look at this report and they can determine different things about you, such as your character, okay? Your character comes into play with your credit report. The way you pay, whether you make on-time payments, whether you have some late payments on your account, whether you have some accounts that have gone into delinquent status even, and you've missed some payments. This all tells the lender a little bit about you, okay? 3 major credit bureaus that we use here in the United States are Equifax, Experian, and TransUnion. And they're all private individual credit bureaus. So the information that they contain may vary a little bit. And also, these credit bureaus, they send out your credit information to different businesses, to different creditors, to different employers. So this information that they keep needs to be accurate, okay? So you also have the ability to check the accuracy of these reports that they compile. You can go to annualcreditreport.com and you can get 1 free credit report from each of these credit bureaus once per year. How many people have done that already? Okay, very good, very good. What I like to do is I like to get Equifax at the beginning of the year, and then I also like to get Experian maybe towards the end of the year, and TransUnion, or Experian probably in the middle of the year, and TransUnion at the end of the year. That way I'm monitoring my credit all year round, okay? So since you're able to get 1 free credit report from each of these, I highly encourage you to do that so you can check out your information, make sure it's accurate. Check to see if there's any inaccurate information on there as well, because that is definitely a possibility. So bureaus compile and report your information, such as payment history is on there, your public records, your personal information, your inquiries, and they send this information out to other businesses, okay? Do I have any questions so far? Feel free to stop me and ask me questions at any time, all right? Any questions? All right.
I don't have a question, Courtney, but let me, because I saw about 4 hands that went up that when you said, have you checked your credit? So how many have in the last 3 months taken a look at your credit report?
I have the Credit Karma.
Okay. So you might have an app or you might have something of that nature. So those are the 3 major credit reporting services. So guess what? They're required by law to give you a free credit report once a year. Yep, annualcreditreport.com is another good one to use. And as Courtney said, you could stagger that out, right? They're pretty much all the same. I mean, the same information is there. Depends on the creditor and who they're, sending their information to. But it should be the same. You shouldn't have your score, let's say, it's 700 on Experian, and then it's a 500 on TransUnion. So it should be the same. Why is it important to check it regularly? Okay. Updates. I heard scamming people. Identity theft. Have you heard about that? Yeah. You had your hand up as well?
Yeah, just to see how you're doing.
Exactly, just to gauge it. Identity theft is real, right? And so to Courtney's point of, staging and kind of staggering that out, that's important because if you only look at it once a year in January, guess what? That's another 11 months that things can be going on. And usually folks don't know there's an issue until they come in to see us. And they're like, well, I don't have a home, right? I don't have the other vehicle, and those things happen. So yeah, by all means, and you may think, and some have even said, hey, I don't have any credit. So I don't check it because I don't have any credit. Well, someone could be borrowing your credit. So it's important that you do that. There are various models, to do that, but hey, it's free and they are required to give it to you. So check it periodically throughout the year so that you just stay in the know. But it's critical for you. Okay?
For sure, for sure. So we'll take a look at the power of time when it comes to your credit report, okay? So most of your negative information reported on your credit report stays for 7 years. 7 years is not forever, Okay, so that's good news. But still 7 years is quite some time, you know. Negative information can be things such as late payments, missed payments. Chapter 13 bankruptcy is even reported for 7 years. Chapter 7 bankruptcy is reported for 10 years. And I just want to pause and just explain the difference between Chapter 13 and Chapter 7 bankruptcy, okay? Both of them are options that you can use in order to get rid of your debt. If you find yourself in a financial bind, you can legally file for these type of bankruptcies. Chapter 13 allows you to file and keep your assets, such as your property and your cash, okay? But Chapter 7 allows you to file and you have to surrender these assets, your property and your cash. And that's why it stays on your report for a little bit longer, okay? And with Chapter 7 bankruptcy, you'll have to go to credit counseling and all of that before you file. And those are the main differences between those two. I just wanted to clarify that for anyone who wanted to know. And collection accounts are reported 7 years from date of first delinquency on original account. What this means is collection accounts, they keep the same date of delinquency no matter how many times a collection account is sold. Because sometimes these collection agencies, they sell your account to each other. They have their reasonings. Maybe they don't think the borrower is going to pay, so they go ahead and sell to another collection agency. But that does not restart the time of that account going delinquent, okay? It has that set date and it just stays on there for 7 years, okay? And positive information can remain indefinitely, which is good news, okay? So your positive information, such as your on-time payments, your loans that have been paid off in full, this continuously gets reported. So that is great news, okay? So that's why I just want to stress the importance of making sure we're making those on-time payments so that this information can continually get reported and make your credit score go up, okay? And your FICO score emphasizes the last 2 years, okay? But wait a minute, like most of the negative information is reported for 7 years, but the FICO score is emphasizing only 2 years, okay? This is good news as well, which means that most of that negative information, once it hits year 3 all the way to year 7, it has less of an impact on your FICO score, okay? So that's great news. Not that it doesn't have any impact at all, it's just FICO is really emphasizing the most recent activity, 2 years, okay? So that is great news. Now let's take a look at credit scoring. Your credit score is what lenders use in order to determine what interest rate you will receive on your loan, okay? And FICO score ranges from 300 to 850, okay? With 850 being considered excellent and receiving the best interest rates and terms on loans, okay? And as you can see, I don't know how well you guys can see the numbers on this, but 35% of your credit score is payment history, okay? This is the factor that they look at the most when determining what credit score you will receive, okay? So what is the factor they look at the most? Payment history, okay. Please remember that because if one way to really mess up your credit score is miss a payment, okay? Make a late payment even. That is one way to mess up your credit score because that is what they are looking at the most. That's the big chunk of this pie right here. The next chunk, this 30% right here, is your amounts owed. Okay, they're looking at your overall debt. They're looking to see how much debt is this person actually in. Okay, so they're looking to see how much credit you have taken out and they're making a determination on what score to give you based on that information. Okay, and the next thing that they look at is your length of credit history, which is this 15% right here. They want to see an extensive credit history on your account, okay, on your report. So they're looking at least 2 years of credit history is what they want to see for each account, all right, typically. And 10% is also this new credit they're looking to see how much new credit you have taken out, how many new credit applications you have applied for. You don't want to apply for too much new credit all at one time, okay? Because this is 10% of your score. It kind of sends a message to lenders that maybe this person doesn't have enough savings in their account, and maybe they're depending on credit to pay for expenses. And so that just concerns lenders just a little bit, all right? So you want to watch out with getting too much new credit applications. And also the last 10% here of this pie is your types of credit used, okay? This is what lenders like to call your credit mix, okay? They like to see installment accounts. Installment accounts are things like your auto loans, things like your mortgage, things, payments that you make that don't change, that normally stay the same each month, okay? And revolving accounts are things such as your credit cards, your balances on those. They don't stay the same every single month. They vary. So they're looking to make sure that you can manage both installment accounts and revolving accounts, okay? So they're looking at these and assessing your credit score that reflects that, okay? Typically what lenders like to do is they like to see that new account open for at least 2 years. And after that 2-year mark, they don't really consider it recent after that. Age is definitely good. They like to see that you have that credit history, that you've had credit for a period of time. They like to see extensive credit history, so age as well. But sometimes it just, like I said, it just depends on the person. Sometimes it may be ideal to get rid of that older account. Let's say you have a credit card and that annual fee is $500, because sometimes these annual fees can get up there on these triple, quadruple platinum cards. Okay, so let's say that's your oldest account. It may be ideal in your financial situation at the time to get rid of that older account because you can't afford that annual fee like you used to at one point in time. So it just really just depends on your situation.
One of the things that we would say that longevity and your length of credit history, but you can see in this mix that length of credit history is what, about 15%, kind of in there. So it is important. So if you're even considering paying off debt, we would say pay it off, but don't close it, right? Because that length keeps that going. But then what does the mix look like? To have that in there too. So it's hard to give you that definitive answer that says go length or go mixture. It all depends on what you're wanting to do, your stage of life, if you're borrowing, and what you need that mix to look like. I would say as you are, starting out, you don't want to accumulate too quickly, because that can also ding your credit for a period of time. You can build it up, but you don't want to run and get open a ton of credit cards and things like that, because every time you do that, that's going to hit your credit. But there is going to be a point where you want to have a healthy mix, because let's say, hey, I'm getting ready to buy a home, so I need to have that mixture in there. Then there might be a point in life where you don't need that healthy mix, but you want to maintain that longevity. So the answer is just not a black or white, straight cut answer. It just depends on where you are, kind of life stage as well. So hopefully that helped in that. Perfect.
All right. And also I want to mention inquiries. They're not listed on here, and a lot of people, I've heard in the past, a lot of people just really placing a lot of emphasis on inquiries, which inquiries do come into play with your credit report. They stay on your credit report for 2 years, those hard inquiries that are used for credit applications, but don't put more of an emphasis on inquiries as you do these two things right here, your payment history and your amounts owed overall, okay? So I just wanted to mention that as well. Okay, so in order to improve your FICO score, there are some various things here listed that you can do. One of the first things you want to really take care of is repay any old delinquencies, okay? Any payments that have been late, any payments that have been missed, you want to take care of these as soon as possible. Because a lot of times, some lenders won't even extend credit to you if they see outstanding balances on your credit report, okay? And also pay consistently on time, because 35% of your score is based on what? Payment history, for sure. So you always want to make sure you're paying consistently and on time. And keeping your balances significantly lower than the limit, 50% or less. I've also heard 30% or less. This is your credit utilization ratio I'm talking about as far as your credit cards are concerned. Let's say you have a credit card with the limit of $1,000, okay? So lenders are looking to see that you stay under $500 with that credit card. You want to stay under a $500 balance, okay? I've even seen some lenders say 30%, which drops you down to $300, okay? So just know that just because you have that limit of $1,000, that doesn't mean that it's not going to affect you if you reach that $1,000 limit. Lenders don't like to see balances maxed out on your credit card, okay?
Right, so you'll notice if you're part of a credit reporting agency, some of you mentioned annualcreditreport.com, or with your financial institution, we offer through credit score where you can look at it, you can check it daily if you wanted to, or monthly. And sometimes you'll see a fluctuation in your score. And so if 1 month, to your point, you maxed out your card, you were buying some furniture or doing whatever, you may see a little downward turn. And that's because of that availability. Next month, you're paying that all off, when it's reported, I should say. And usually that's within 30, 45 days. Once they hit it, then you'll see your score go back up a little bit.
And a lot of our financial institutions, I don't know if you all have online banking and look online at your credit report and notice that your financial institution is reporting your credit. Who's done that? Logged online and been able to check your credit report. They seem to update monthly as well too, just like the credit bureau's report. So you can typically go on there for free. Most of the time your financial institution provides this for free, okay? All right, so keeping your oldest accounts active, that's good because lenders like to see that extensive credit history, like to know that you are making payments on time for a long period of time. But sometimes it does make sense in certain financial situations to go ahead and close some of these oldest accounts, but best practice is to keep these things open even after you pay these items off, okay? And you limit your number of open accounts. Limit your number of open accounts, okay? And when you have too many open accounts, it just sends that message to that lender again that maybe this person doesn't have too much savings in their bank account. So they want to make sure that you are not relying on credit for your expenses. And limit the number of credit applications made for that same purpose, okay? When you have good credit, how do you make it go up? Well, for one, continue to make those on-time payments. That will definitely help your credit. Sometimes you may notice a standstill if you don't have a good mix on your credit report as far as installment accounts goes, as far as revolving accounts go. Sometimes your credit history can come into play. Maybe you just need to continue to just let time run its course and just continue to wait for your credit history to get more extensive. And sometimes you can realize that these numbers do go up later on. Say you have, and this is just an example, say you have 5 open accounts and you have 0 balances on them all. And let's say that your credit limit for all of these accounts combined is like $25,000, okay? So the lender is looking at your report and saying, okay, this person has open accounts, no balance, which is good, but let's say you decide to go on a shopping spree next month. You can run that up to $25,000. They're just looking at that as a possibility, okay? So that's why they're saying limit the number of open accounts that you have, okay? Just because they know you could be okay today and in debt tomorrow, so to speak.
You know, sometimes you get those emails say, hey, we just increased your credit limit on your card. That's great, just don't use it. Right? It's fantastic to have. You gotta take a little discipline not to use it, but what that does is it increases your availability. So that's good to have because remember that part of the pie and your usage. So if you've got you had a $1,000 balance, now they increased it to, because it's holiday time. A lot of times you'll get that around the holidays. Oh, hey, go shop, have fun. Don't dare. Don't you dare do it. But if they move that from 1,000 to 5,000, guess what? Now you have another 4,000 extra that's added in there. So
A cent being
Accept it, don't use it. Yeah, and if they're doing it that way, which is really cool because it's not a hit on your credit. So you're not going to the financial institution asking for it. What we're doing in the background is we're looking at things through TransUnion or whatever and saying, hey, this person has, this level of score, so we're going to offer them that amount. So that's great. It doesn't affect your credit. It's not an inquiry on your credit. It's the financial institution, offering it to you. So take it, but don't use it. Now, if you were to go, let's say you had a credit card with the credit union and you would call us up and want to do that. Hey, I want to increase my credit limit. Okay, we're going to have to pull a credit report, right, to do that. And so that's where that becomes an inquiry. So kind of like the ding. So if they extend it to you, take it. Just don't use it.
If you ask them to the hard pull or like something.
In that case where they're offering it to you, that's a soft pull because we're going in the background and we're just looking at credit, and then we extend the offer to you. That's no hit on your credit. If you contact us and say, I want to increase my credit limit, that's a hard pull. So that's one that then goes to the credit report. What's really cool is we have not only our member service counselors in all of our branches that can certainly answer those questions for you and help you that way. For our members, we also have a service, a financial education service, financial resource service. It's called Balance. And that's free to credit union members, and you can speak directly with someone that actually take a look at your credit report with you and walk through that process with you. So that's a cool, another added benefit of being a member, and it's free to our members. So those services, those resources are available to our members.
It's good that she is an authorized user on your account and building her credit history based off of your payment information, which is great. Lenders, again, like to see that extensive credit history. Typically 2 years is the magic number, I guess, that they're looking for in order to consider you pretty much established on this one account. So, it just depends on what's best for you.
I did it with both of mine, right? So I had them through high school, and then they went off to college, and I said, fly the nest, birdie. There you go. So it might take that down a little bit. So with my son and doing that, I said, okay, now you've got it, and let's get you a credit, because you came to credit union. I said, just start out with a little $500 limit, because I just want you to build it, right? What you're gonna do is put your gas on it and your little incidentals while you're in college, not the accidentals, because you're gonna pay for those, but I'll help you with the gas and the incidentals, and you're gonna pay it off every month. And so you're gonna put on, pay off. And did that, so the score dropped just a little bit by doing that, removing from my card, had his own card, but he started out in a good place, because kind of start out in B paper credit sort of thing. Did that for a year, and after a year I said, okay, now go back to the credit union, say I want a credit increase for that. Did that. In 1 year he went from 670-ish range to a 705. Just in a year of putting on, paying off. So from a B to an A paper. So it can move. So I mean, yes, there might be a little bit of a decrease in that, but then she's completely on her own and she's already established with the other card. So 6 months to a year, she's gonna see some traction moving up. Okay, and that'll get her completely independent.
But the credit she'll be able to get will take it back.
It'll take care of that. Doing those sort of things, making sure she's not going over that limit increase, keeping it, the short. If she can put it on, pay it off, every month and kind of run that, she'll have it up. So it won't be that period of time, and it won't be a drastic drop where it's gonna just take her. Yeah. So let her go, let her fly.
Like, do your rewards increase as your credit limit increases?
Correct. Does it change more?
Not typically, no. No, you'll basically still have the same rewards that you had at the lower credit limit.
Sure.
But you just won't have that, as far as your credit report is concerned, you won't have that hard inquiry on your report if it's something that the lender is extending to you.
As far as the points.
Oh, the points, yeah. Usually points are all based on how much you're charging on the card. So you'll have access to more because your limit is higher. Well, I thought you were talking about reward points. I'm like, that all depends.
Oh, okay.
Actual credit points.
Okay, like your credit score, does your credit score increase? It depends. It depends if you're limit is increased.
It helps. It's not going to, I get what you're saying. Like if I go and now I've got a $10,000 limit,
Right.
I had a $2,000 limit before, boom, do I get 15 points? It doesn't happen as quickly as that. Yeah. So you will see a gradual increase. Now, keep in mind, all things equal, and you're doing what you need to do, and you're keeping it really below a 30%, mix of that. So all things equal, you're going to see that over time, that score increase, but it's not like you're going to get this boost of, now my credit score has jumped 20 points, because of that.
All right, so I believe pretty much a lot of people in this room have already established credit, is that correct? Okay, very good. And you can also reestablish credit as well too. So you can do this by repaying your old debts. This is something that lenders like to see. Those outstanding balances being paid. These can be paid through payment arrangements and also settlements. Okay, another way that you can establish credit is getting a secured credit card. This is where, like say the financial institution or the creditor will put some money on hold and they will extend you a credit limit that is equal to the amount that is on hold. Okay, and then you just make your monthly payments. And as you make those monthly payments, your activity is being reported to the credit bureau, and it's extending your credit history some. And you will notice that once you pay that loan off in total, that money that's on hold in your account will come off. Okay, come off hold, and that's an easy way for you to build your credit. And I know we talked about a cosign loan a little bit earlier. You can also, if you know of a family member or a friend maybe who has a great credit score, great credit rating, ask if they can co-sign on a loan for you if you're not able to get a loan at all, or if you're not able to get a loan with the desired terms that you're looking for, okay? Maybe a friend or family member will co-sign for you. Maybe a friend or family member has asked you to co-sign for them. But what is one thing you want to be careful of, you think, when it comes to these loans? What is it? When it comes to a co-sign loan, what is one?
Make sure you trust them and they make their payments.
That's it. Make sure you trust this borrower if you are the co-signer on the loan, and if you are the one borrowing and you have a co-signer on there, make sure that you guys have a payment plan set up so that your credit is not affected as a co-signer with a borrower on the loan, and their credit isn't affected. So two people's credit is being affected with one loan, okay? So this is very important, all right? So keep your credit report accurate as well too, okay? Keep on doing those checks yearly, making sure that your information is accurate. Well, they do pay attention to your personal credit when it comes to your business credit, but they are two separate things that are scored differently, okay? So you definitely want to make sure that you have of course, your personal credit in good tact before, applying for business credit, as they're going to take a look at that and make sure that you are someone they can extend credit to.
Today, the credit union does not offer business loans. So for us, it is something, hopefully future state will be looking at business accounts and things of that nature. So today, it's only personal lending that's involved. So for us, as we're looking at that, it's strictly on the personal level. On the business side, it all depends on how you have that set up. And so I would recommend that you consult with someone if you're looking at that. Is it an LLC? Is it this, and does it look at your personal data and that sort of thing? Because sometimes it doesn't. So it depends on how it's structured. Well, it's based more on the business plan and the business loan. So it's not a true FICO score the way that you would on a personal basis. Yep.
Reporting agency on that, will this reflect in my American credit score or profile?
Ooh, that's a good question. Do you know about that?
Let my caveat say, let me say this, and my disclaimer will be, I'm not an international lender, but to your question, if they are not, so I can only tell you from our perspective, kind of what we look at in that credit scoring. So if they don't, and let's say you've got a loan or something that's done internationally, and they're not reporting that to us, they're not factoring it in, we won't have it. So that could be to your favor or not, because it's not on your credit report, but then you don't have the history of it either. So it's all going to be on what they would send over to us.
All right, so let's take a look at some of these companies that claim they can repair your credit for a high fee. I'm here to tell you that there's nothing that a credit repair company can claim to do that you cannot do yourself for free, okay? A lot of the times what they do is actually illegal. They try to dispute your accurate negative information, and there's no way you can dispute accurate negative information on a credit report legally. There's no legal way to do that. So this is what they try to do. And just take steps yourself to monitor your credit and dispute anything that you see on your credit report that is inaccurate, okay? Another tactic these companies try to do is they try to issue out a tax ID number for you, which kind of acts as your social security number, and this is illegal. You cannot do that. All right, so just stay away from these companies, okay? There's nothing you can do that they're claiming they can do that you can't already do for free, okay? And I also want to talk about predatory lending for just a little bit, payday loans especially. I know of a situation of a gentleman who went to go take out a loan for $300, take out a payday loan. And by the time he finished paying off his $300 loan, he had assessed $500 in fees, okay? And this is very typical when it comes to these payday lenders. Astronomical interest rates, okay? When the fees extend past your overall loan amount that you first went in there for, that's a problem, okay? The fees should never be more than the entire loan itself. So just watch out when it comes to payday lending as well, okay? Okay, and let's continue to speak on the role of money management. Of course, paying on time, okay? Making sure you have enough money in your savings for emergencies instead of turning to credit. And asking about settlements, talking to your creditors, paying off your collection accounts, okay? As far as saving for emergencies are concerned, typically a good savings cushion is 3 to 6 months of your income, okay? Is what you would like to save for emergencies. That's good. Does anyone track where their money goes? Okay, very good. This is a great practice. Anyone been to the ATM and pressed fast cash and got $40 and then it just disappeared? You don't know what happened to it. It's just gone like that. This is why I had to start writing everything down, because I had that issue. I would go to the ATM and I would take out fast cash, $40, and I wouldn't know what happened to it, okay? So when it comes to tracking your spending, make sure you write it all down, okay? This gives you a good picture of what you are actually spending your money on. And it's amazing what happens when you write everything down and you just get this picture of your spending habits. You're like, or I'm like, oh my goodness, I can't believe I went to Chick-fil-A 8 times this month. Like, I really just be eating some Chick-fil-A. So that's why it's important for me to write it all down. And if you go to the grocery store, for instance, and pay like $200 some in groceries, of course you don't want to write all these down. You want to keep your receipts, okay? In this situation, keeping your receipts is good. It's a good record of how you're spending your money. Credit and debit cards are good as well, as credit cards have statements that come out after every billing cycle. And debit cards also have statements that come out monthly. They keep track of your spending for you. So this is wonderful to use and take advantage of. Monitoring your ATM use as well too is what I've had to do in the past. Get your receipts from there, from your ATM, and keep those and see how much fast cash you were actually getting out each month, okay? And also computer tracking programs are good to use as well. Anybody use computer tracking programs to have their spending plan? Okay, very good. These are also good computer or tracking programs to use when it comes to knowing what you are spending. live within your means. It sounds a lot easier than it actually is. And you know, sometimes you may find that you need to increase your income in some way or some shape or some form, okay? You may need to apply for that promotion. You may need to get a part-time job. You may need to increase your income by selling your assets maybe. But make sure you don't have any tax penalties first when it comes to selling some of these assets. You just need to get creative with your spending in some cases. All right, look for ways you can reduce your spending. Maybe I don't need to get the brand name in the grocery store. Maybe I need to get the store brand. I can substitute it that way to save some money here and there. Maybe I don't need that iPhone 13 right now. Maybe I need to postpone that for a later date, okay? Because the iPhone 13 right now is more than my mortgage. So maybe I need to postpone that for later on. And maybe I need to forego the iPhone 13 altogether. I don't know. Or maybe I need to forego that vacation that I was planning on taking, okay? So these are different ways we have to take a look and analyze our spending plan to see how we're spending, all right? Let's talk about deleting your debt, okay? If you notice you do have a good credit rating, you can reduce your interest. You can contact your creditors and see if you can reduce your interest. If they can give you a lower interest rate, this will help you pay off your debts faster, okay? And also, if you find that you have some savings in your account, maybe it would make sense for you to increase payments when you're looking to get rid of some debt, okay? And aggressively repay your most expensive debts. Get the big debt out of the way first, okay? Yes, ma'am.
So if I call like Eglin and say, can you reduce my interest rate? Do you have to do an inquiry for that as well?
Yes, ma'am. Yes, ma'am. And it would be a hard inquiry as well because you're looking to have an interest rate reduction. So it would be on your report for about 2 years or so. But it may benefit you in the long run. You may qualify for an interest rate, let's say that's a whole 2% down than what you currently have, for instance. Say you want to, let's say, refinance a home or something. It may be worth it to go in there and have that hard inquiry on your report so you can.
Home, yeah.
Oh yeah, but you can do it for any loan.
Okay.
You can.
Why is the inquiry a negative thing? Just because he's inquiring, why is that negative?
It's just part of the credit scoring. And you may have
Yeah.
some, and so you have to be careful of that. And especially, say you're going to get a new car, right? And so you're going to different lots. Know what you're going into before you get there, right? Because every time they go in and pull, it's an inquiry. So to a financial institution, that may appear that you're shopping for credit, so you can't get it. It's a part of the makeup of the FICO scoring.
You know, another thing I also didn't really understand with lending as well is why do they penalize me for paying off my loan early? You know, how that prepayment penalty sometimes, not everyone does that, but there's some lenders that will penalize you for paying off your loan early. That's something I didn't understand as well too. We don't though. We don't at Eglin, so. So yeah, I just wanted to mention that, just reminded me that was another thing. So let's talk about repaying your debt while saving for goals. This definitely promotes good habits. You're paying off your debts while you're saving. That's good, okay? This will not allow you to rely on credit for emergencies, which is what lenders do not want you to do. And you'll also have cash available for down payments later. Say you want to buy a car or buy a home, okay? You'll have more money for that down payment as you're saving and getting out of debt at the same time, okay? And so I want you guys to think about something, what you are going to do now that you've received some financial education on credit and debt management. Think about some of the things that you can do today. What can you do today in order to increase your credit score? What can you do today in order to clean up your credit report some? What can you do in the next 3 months? What can you do this year? Looking at your short-term, long-term, and mid-term goals, having those all analyze. Just see what it is that you can do, the steps you can take today. When you're a member of a credit union, you become part owner of the credit union, which is a supreme advantage. Also, You typically tend to see higher dividend payouts when it comes to credit unions as opposed to banks, because credit unions don't have a financial interest within your account as banks do. Banks are governed by shareholders who do have that financial interest. They're looking to make money. They're looking to make a profit. And typically you tend to see higher fees with banks. You tend to see higher interest rates even. Whereas with credit unions, they're governed by board of directors, they're volunteers, they're not paid, so they don't have a financial interest in your account. So that's why you can see lower rates. That's why you can see higher dividend payouts, and that's why credit unions just rock. So, as Ms. Nico stated earlier, Balance is our financial education and counseling service offered for free through Eglin Federal Credit Union once you're a member. And you can see on here, services include money management counseling, debt repayment options, credit report review. They have articles, they have podcasts, they have videos, they have a plethora of resources there.
So I'll tell you.
I know as far as mortgages are concerned, lenders like to see like at least a 620 score and no outstanding debts.
Well,
As far as applying for a mortgage is concerned. Income, it just varies. They just want to make sure that you can pay that loan that you're applying for. Your income can vary.
yeah.
Okay.
So we have a couple different things. You have in those credit scores, you have tiers, okay? What's important to know, and I kind of laugh at the 850, but when you see on the billboards, oh, you can get this as low as, right? For whatever financial institution you see that, consider that for A-Paper members. So A-Paper, you're looking at about in the 7 range and up, right? 720 range and up. So you're getting those higher scores, right, based on that. So there's also a portion of that that's called debt to income ratio. So, and it varies based on the financial institution. Some might say, hey, we want your debt to income ratio to be 40%. We won't go over 50%, which means then that as you look at your income, you look at your expenses, you want to make sure you're not paying out more than that 50%. And then they take into account the loan that you're actually getting as well too. So they'll kind of factor that in to see if you're going to stay below that ratio. That varies from financial institution to financial institution. So it's just a matter of how much risk they're willing to, to take in that. So the score is not everything, but the score is a big chunk of that decision. Okay? All right. All right.